Stinking weather people lied to me. This big giant blob is gonna kill this. Yeah, they have it green, but it's actually snow. Terrible. Blizzard and such, blah blah blah. Oh, it's gonna be horrible. Anyway, awful cold with snow. It's gonna drift. Nothing good will happen. Anyway, Modern Mystic made a video on the Federal Reserve stuff, and I don't know. I didn't like his video much, just because it's, you know, it doesn't say enough. It doesn't explain enough about this whole banking thing. So, and why there's money in these reserve accounts at the Fed. So I just thought I would try to do something with it. Try. It can't hurt, right? I mean, you'll get mad at me or something, or say I'm wrong or whatever, but it doesn't matter. There's got to be a reason for it, and I'm just going to explain. I mean, the way he's describing it, I don't think is accurate. So anyway, so let's just say you got this bank thing. Okay, we'll draw a picture. So you got this bank. This is bank. And then we have this Federal Reserve System, which means you have these regional banks. And they collectively represent the Federal Reserve Bank in a way. So what happens is as the bank does business, it's regulated in the sense that it has to keep a reserve with the Federal Reserve. So when they put out currency, what they do is, the idea is they provide banks with cash. Okay, the Federal Reserve, I don't know, how do you draw printing the cash? But anyway, they make the cash, and so they decide how much cash is going to roll out of the presses, so to speak. So they make the money, and there's going to be a certain amount of it that's going to go out the banks. So the banks are going to put the money out. So this money goes through this system and comes out here, okay, into the economy. And what's happened is the amount in the economy at any one time changes over time. And so a few years ago it was less than a trillion. You know, it was 1 trillion, and now it's over 3 trillion. So there's been this expansion of money supply, you know, money in the economy. And you know, because the Fed produced more money that went out of the banks, because it opened certain doors that say, go ahead, put more money into the economy. Now, what percentage of that money is going to end up, something's over there, anyway, end up back, goes back to the Federal Reserve. So what happens basically is banks give out the money, they take back in money, obviously they make profits, and they have to give back to the Fed in terms of these reserve accounts they hold. They give the money back to the Fed for the money they lent out, so that the books are kept even. The banks don't get to print the money. They do have to have an accounting, and they have to keep reserves, a minimum reserve account amount, to pay off the outstanding debts, you know, in case there's a run on the bank kind of idea. So anyway, the real problem is those reserve amounts are way down, like whatever, 10% or something. So they don't have to hold very much in terms of these reserve accounts, how much money they hold in the vault. This is really their vault. You know, their home vault doesn't really exist anymore. This is where the money's really kept, is with the Federal Reserve. So anyway, but there is a bookkeeping. I mean, the Federal Reserve doesn't just give the bank money and say, go ahead, give the money away for free, make a profit, and keep the money. No, the bank has to pay back the principal. It has to pay back the original money. It gets to keep the profit, but it has to pay back the original currency it lent out to the Federal Reserve. And so, like I said, it's all done through these reserve accounts. So if the banks have a deficit, like if they produce some cash, through they let out more cash, the Federal Reserve gave them cash, and the giving the cash thing is separate from these reserve accounts, I suppose. So technically the Federal Reserve just gives them the cash this way. The bank says, give me cash, they give them cash, cash goes out, then when the bank gets paid back, it pays back the cash it used. So the Federal Reserve gets back the money. And the money comes back in the system because this money gets old and it has to be retired. So all the bills end up going back to the Federal Reserve, the Federal Reserve cleans them, and it just balances the accounts. So when it goes to clean the money, if the bank owes them money, it just burns it. Just says, fuck it, we'll just burn that money. It doesn't reissue money to the bank for that purpose. It just pays the bill the bank owes in terms of the money the bank issued, the cash it issued. So the reserve accounts are the bank's money. Okay, so these reserve accounts are technically the bank's money. I don't know how they initially started the system. Maybe it was the Federal Reserve's money, but I don't know. Now, technically, it seems like it's pretty much the bank's money. And so what's happened is these reserve accounts are all full of this $3 trillion. Instead of staying out here in the economy and, going through transactions and all that kind of crap, and even going back and forth between banks, this $3 trillion has ended up flying back in here. So all the excess money over this $1 trillion that used to be seems to have just gone into these reserve accounts. And it's in excess of this 10% number. So the banks aren't required to keep this much money in here. They're doing it because they want to keep the money in the bank. And the Federal Reserve is paying them some whatever 0.5% interest or something. Some amount of interest is being paid, and that's what encouraged the banks to start building up money in these reserve accounts, as they were making interest on it. Now, to me, it doesn't seem like enough interest to justify a bank doing this, but maybe regulations mean banks can't go out and buy some Google stock or something. Especially with reserve accounts, you would imagine they can't do that. The bottom line is, okay, so what's basically happening is, let's say the stock market goes up, and everybody's looking very rich, and so everybody's paying their bills, and that means the bank is making lots of profits, and so that's why lots of money is going into these reserve accounts. It's because the banks are all looking pretty happy because everybody looks like they're rich. So now, but as soon as the stock market goes down, well, everybody will be looking poor, nobody will be paying their bills again, and now all this reserve money will have to go back to just pay the basic functions of the outs going out of the bank. And so the bank, instead of making profits, is going to be paying off losses with its reserve account money. Probably. That's the way it's going to play out. But the bottom line is this is all accounted for. This bank does not get to print money. It has to take it from the Federal Reserve. There is an accounting, and it has to pay it back. It has to go back to the Federal Reserve. So when this amount goes to $3 trillion, if it ever goes back to $1 trillion again, it'll go back to $1 trillion again because enough money was owed to the Federal Reserve from the banks, in terms of the money they lent out, versus the money they took in, and so they had a balance to pay off. So the way it is now, the system, obviously the banks aren't lending money, so they're not taking money from the Fed, which means that they're just paying the money back. So you would assume that their bank books are clean in terms of what they owe back to the Fed, you would assume. I don't know what they owe the Fed. But obviously the Fed is in deficit. So the reason why all the money is stuck in these reserve accounts is because it doesn't belong to the Fed anymore, because they basically bought bonds and other kinds of crap with the cash money. So they took cash and they told the banks, buy some crap for us. And then I think what's basically happening is the crap is ending up in these reserve accounts. Technically, the crap, in terms of they're technically cash, but they're cash leveraged on holdings of U.S. bonds and other paper that the government has insured. And so what I think is happening is if a bank holds U.S. bonds, or it holds paper that the government has FDIC insured, which it did with a lot of the savings and loan bad paper, a lot of that is FDIC insured, so it's all crap paper. It's like really bad stock. The government just says, I'll guarantee it, so the stock stays alive, even though it should just go bankrupt. It should just be declared crap, but because the government guarantees it, people still trade it. And I think if the banks hold that in their vault, so if they have bonds, U.S. bonds, or they have possession of government-insured paper, they can use that as collateral, as a statement, to increase their their whatever you want to call that, their assets, and therefore their reserve requirements even go down lower in a sense because they're using this crap paper as reserve. So it's not like it's cash money technically. I mean, they can't loan a bond, so but they're getting a cash equivalent in terms of their reserves. They can put cash, all the cash can go into the reserves, and they'll just keep the crap paper in their own vault. So they put all their real cash in the Federal Reserve vault and just keep the crap paper in their own vault, and something like that, I would assume. But the bottom line is the federal government has put this money out into the economy with the idea that it would stimulate the economy and create more loans, and it hasn't created more loans because there's not more reason to give out bad loans, because they already got burned on that bubble crap once, and everything's bubbling, looking pretty bubbly again, so the banks are bubble shy, so they're not going to let money go out on stupid loans. And so, yeah, they're not pushing the money out. They're not feeding this money out into the system because there's no buyers and there's no good buyers of the loans. And so it's just piling up in here and as kind of a profit. And the great thing about this as profit is you can put your profit here and also get interest on it, kind of a thing. And I guess they'll take the money out when it's to their advantage in terms of tax purposes or some other reason to take profits on their profits. So that might be part of it too. They're waiting for a more opportune environment to declare the money that's in the reserve accounts as profit and pay the minimum amount of tax on it. Something like that. But the bottom line is this is a real effect. This isn't a fake effect. It's a real effect, okay? I mean, they're putting more money in reserve accounts because they're loaning less money. Well, they're loaning, less is tricky, right? They're loaning the same amount they were loaning back when there was only $1 trillion in circulation. So they're still loaning money, but they're just not loaning enough to maintain $3 trillion in circulation. So, $2 trillion of it had to go somewhere, and it went into reserve accounts because it couldn't stay in the economy because there's not enough new growth to justify that much loaning activity. And banks are in the loaning business. And they're certainly not going to be loaning people money when people are making huge amounts of money in the stock market. So even that fails. I mean, people aren't going to be borrowing as much money if they're making more money. The rich anyway. Yeah, so I guess that's part of the equation. But anyway, horrible drawing, and I'm just saying that the individual banks can't just write up money. They have to write it in a book. And as much as the government doesn't regulate it, regulates enough to look at their books now and then and say you can't just, you can't write more stuff than you got in reserves. And the point is they're so profitable right now that they've got much more, like this 10% number, they're way over that. I mean, they probably got 30%, in their reserve accounts. So they're way over the necessary amount in their reserve accounts, I think. Unless they have a lot of outstanding loans that are not paying. I mean, if they have a lot of bad loans, then maybe the reserve money is necessary because they have a huge, their asset sheet has a huge liabilities on it. But I think it's the other way around. I think because of the stock market going up, they have huge profits. And the whole reason why the stock market went up is because all this money the government printed to buy its own bonds, the money that would have bought those bonds, right? So when the government buys, say there's an outstanding bond for $1 trillion worth of U.S. bonds, and the government has to pay it off, right? And it doesn't want to tax people to pay off the bondholder, so it just prints the cash. So when it prints the cash, just prints it and pays off the bondholders. The bondholder gets a whole bunch of cash that's now free in the economy because this bond doesn't have to get resold, right? Because we bought it. So now the money that would have gone to buy this bond, this U.S. bond legitimately, there would have been real cash coming out of the economy to buy that U.S. bond. Now that money stays in the economy, and so these rich people can invest it in the stock market. So essentially, every time the U.S. government buys its own bonds, it's basically just liberating rich people to invest the money in the stock market. Because those are the people who buy bonds. Those are the people that hold bonds. So they're just taking the money that rich people would spend on a U.S. bond, and they're basically just liberating it to go get spent on stocks instead. So that's why the stock market goes up. So when the U.S. Treasury buys our own bonds with cash, they're just freeing the rich man's cash to go buy stock market assets. So the stock market goes up. But obviously they can't continue to do that. So sooner or later they'll stop deficit spending, or they'll stop buying their own bonds because they're going to ruin the value of the cash, create huge inflation potential, even though we're in a deflationary, and we're only in deflation because wages are going down all the time. I mean, just keep going down and down and down. There's no wage pressure, so you can't create any kind of inflation. But eventually, when peaches are $5, there's going to be wage pressure because everybody's going to say, I ain't going to work for, I'm not going to work for $10 an hour when a peach costs $5. You're going to have to pay a lot more than that. But anyway, yeah, so that's the doom eventually. And, we're heading for it just because the stock market can't stay where it is, because the stock market is made out of just grotesque, all the government's done for the last 4 years, under Obama, 5 years, and under Bush, but it was worse under Obama. All it's done, it's either deficit spent $2 trillion a year, or it's print $1 billion in cash. But it hasn't legitimately done anything. I mean, it just keeps putting debt money into the economy, and the debt money is in a form, isn't structured, so that it's going to end up in the stock market. The debt will end up in the stock market, and it'll make the stock market go up. The rich are getting richer off of our deficits. But obviously, since we can't pay the deficits, it's not a good plan. It has no future. Yeah, there is no future in it. So anyway, yeah, this was a mess of a drawing, but there's no money printing. It isn't happening. It's just not. It just isn't. It's accounted for.